Let's pretend we're at a wonderful beach city in Italy, one of my favorite countries, where a man named Matteo, peddling trinkets to vacationers. He just has one thing for sale, but it's a stunner. A cup of multicolored glass. He packs up his €100 and heads out the door to meet with the souvenirs manufacturer first thing in the morning. Matteo spends his €100 on 100 cups, since each one costs €1. He walks to the beach to sell the cups to visitors. He sold them for €5 each, and by noon, he was out. He is happy and goes home. The next day, he does the same thing. He wants to know how much money the business made after a month. What if he sold multiple things? Which one made more money? Would it make sense for him to rent a permanent stand at the beach to grow his business? Without a way to keep track of what his business does every day, he won't be able to answer these questions. This is possible because of accounting. Matteo's every financial move will be recorded, and he will also get detailed reports that sum up how his money is doing. These are called financial statements. Income statement equals revenue expenses. Let's start with how much money Matteo makes. If you want to know how profitable a business is, you can look at its income account. This is one of the most important comments about money. There, you can find out how much a business made in sales during a certain time, how much it cost, and whether it made a profit or lost money. You might hear the income sheet called something else. What do you think it is? Profit and loss, or P&L? It's a pretty simple way to run a business, and this is how Matteo's P&L would look. Each of the 100 glasses he sold went for €5. This is called sales or income, and it was €500. He didn't get the glasses he sold for free, right? To buy them, he had to pay money. He paid €1 for each glass. So, all of his costs added up to €100. This is called the cost of things, and it needs to be subtracted from the income. To keep things simple, we don't think about fees and taxes right now. If we add everything up, we can see that Matteo made a profit, or a net income of €400. This is how a simple statement of income would look. Sheet of accounts. Next, we'll take a quick look at the balance sheet, which is the second most important financial statement. The balance sheet shows the company's assets, the money it owes to other people, and the money the owners have in the company. Most of the time, assets are valuable things or tools that a company owns and uses. Some examples are land and buildings, office tools, inventory, or cash. What you owe to other people is called a liability. For example, a bank loan. What you owe your suppliers for things, or what you owe the IRS in taxes. The third part is fairness. This is a little more vague. It's the amount the company would still have if it sold all of its assets and paid off all of its debts. In other words, it is the difference between all of a company's assets and all of its debts. This extra money goes to the people who own the business. On one side of the balance sheet are the assets, and on the other side are the shares and liabilities. If you draw a line between them and put one on top, you get the shape of a T. This is what accountants use to see how deals fit together. It's a very useful tool, and we'll use these T accounts over and over again. You can see that the left side of the T is the same size as the right side. All of the company's assets, or things it owns, were bought with either borrowed money or the company's own money, which is called equity. For money to go into one account, it has to come out of another. This is what we call a flow of economic benefits from one place to another. We've already said that equity is the difference between assets and liabilities. Putting this in a different order gives us assets equal to bills plus equity. The name balance sheet comes from the fact that both sides are always equal. The accounting equation is the most important part of any accounting system. The total amount of assets is the same as the total amount of debts and property. Both sides are about equal. Keeping this in mind, let's look at Matteo's balance sheet. A balance sheet is always made at a certain time, like at the end of the business year or the end of a quarter. Balance sheets for Matteo at different times. In our example, Matteo's workday is over. Matteo started out with €100 in cash, which was also the money he put into the business. This money is called equity. The cash on the left equals the value of the business on the right. At this point, the bank sheet is in good shape. The next morning, he used the money to buy the colored glasses. His stock is what we call the glasses. In the process, he lost all of his cash, but he got another asset in the form of goods. He didn't get any more or less money, right? The total value of his assets is still $100, which includes his stocks and bonds. At the end of the day, he had €500 in his pocket, because he sold each glass for €5. All of his glasses are gone because he sold them to tourists. So, at the end of the day, the value of his stock is zero. He has run out of glasses. If we look at Mateo's balance sheet at the end of the day, we can see that his assets are worth a total of €500. The left side, that's how much money he brought home. We only have €100 on the credit side. The balance sheet doesn't look right. We know that this can't be true. Both sides should always be equal. So, what's the problem? The part that's missing is how much money he made during the day. If we look at Mateo's income account again, we can see that his net income was €400. Why will this be added to the equity? Because he made the business more valuable by making it work well. At the beginning of the day, it was only worth €100, which is how much he put into the business when he left. When he got back home, he had sold all of his glasses and made €400. So, the value of his business has gone up, which is shown by a bigger equity. The link between the income account and the balance sheet is the net income. So, when we add the €400 in profit he made to the stock, the total on the right side is also €500, and the balance sheet looks right. So, that's what Mateo's day at the beach would look like when it was over. I hope this video helped you learn some of the basics of accounting. Until next time, see you later.